There is a number that keeps coming up in conversations between macro analysts, commodity traders, and some of the most cautious institutional investors in the United States right now. That number is 36, not 36%. 36 times, as in if one specific ratio in the financial markets simply returns to where it was. In 1980, commodities will outperform the US stock market by 36 to 1 from here. Now, before you dismiss that as noise, this is not a forecast. This is not a prediction from a newsletter. This is a mathematical reading of a 50-year chart, the same chart that gave the same signal twice before in modern history. And both times, the investors who understood what they were looking at made fortunes. The ones who ignored it spent a decade recovering. This week, the chart gave the signal again. But here is the part that made me stop everything and make this video immediately. Because the chart alone would be enough. The chart alone would justify sitting down and walking through this carefully. But there is something else sitting on top of it right now. Something that has only happened 4 times in the last 100 years, something that each prior time was followed by a decade-long collapse in stocks and one of the most violent rotations into hard assets in modern financial history. One of the most respected sentiment analysts in the United States, a firm that tracks unusual statistical readings across the entire history of U.S. markets, just published a data point this week that should stop every investor in this country cold. The S&P 500 is hitting record highs. At the same time, 5% of its own member companies are simultaneously crashing to 52-week lows. In a real, healthy bull market, this does not happen. When the index is rising on genuine strength, the companies inside it rise with it. Breadth expands, winners multiply. What is happening right now is the opposite. The index is being held up by a handful of mega-cap names while the foundation underneath it is quietly collapsing. And the 4 times this exact divergence has appeared in the last century are burned into financial history. July 1929, January 1973, December 1999, and this month, May 2026. You already know what happened after each of those 3 dates: the Great Depression, the worst stagflation crisis of the post-war era, the dot-com collapse, and the lost decade in US equities. And in every single one of those periods, the capital that rotated out of stocks did not disappear. It went somewhere. It went into gold, into silver, into oil, into copper, into the entire commodity complex. The hard assets that the stock market had spent years dismissing as irrelevant suddenly became the only game in town. We are now living inside the 4th instance of that exact setup, and I am going to show you exactly what the data says happens next. Let us start with the chart producing the 36 times signal, because the math here is not complicated. It is just something most retail investors have never been shown. There is a ratio that has existed in financial markets for over 50 years. On one side of that ratio is the Reuters CRB index, a basket tracking raw commodities across energy, metals, and agriculture. On the other side is the Dow Jones Industrial Average, the 30 largest US industrial companies. When you divide one by the other, you get a single line that tells you at any given moment whether real assets or paper assets are cheap relative to each other. And that line has cycled through specific extremes over the last 5 decades in a pattern that is impossible to ignore once you see it. At the 1980 peak, commodities were trading at the highest level relative to stocks in modern history. The commodity complex had absorbed a decade of inflation, oil shocks, and monetary chaos. The ratio reading was extreme enough that it became recognized as the commodity peak of the century. From that peak, commodities collapsed for the next 2 decades as the stock market entered its greatest bull run in history, the 1980s, and 1992's tech and financial expansion that pushed the Dow from under 1,000 to over 11,000. By the year 2000, the ratio had swung to the opposite extreme. Commodities were historically cheap relative to stocks, and that compression, that coiled tension, was exactly the fuel that powered what came next from the 2000 low. Commodities ran for nearly a decade in one of the most powerful commodity bull markets ever recorded. Gold went from $250 an ounce to $1,900. Silver went from $4 to $49. Copper, oil, agricultural commodities, the entire complex repriced violently higher. Investors who understood the ratio and positioned accordingly captured returns that made equity investors of the same period look completely flat-footed. After the 2011 peak, the ratio cycled back down. Stocks recovered, the commodity complex ground lower, and for over a decade, the ratio compressed again, slowly, methodically, building the exact kind of tension that precedes the largest moves. As of this week, that ratio has reached its lowest reading in modern financial history, lower than the 2000 bottom, approaching the same compression levels that, the last 2 times they appeared, preceded decade-long commodity outperformance against equities. This is exactly where the 36 times number comes from. If the ratio does nothing extraordinary, if it simply returns to the 1980 peak level, the mathematical implied outperformance of commodities versus the Dow Jones from today's starting point is 36 to 1, 36 times, not as a speculative target, as the arithmetic output of where we are now versus where the ratio has historically mean reverted. And what makes this more than just a chart observation is the technical structure that has formed over the last several months. A Sweden-based macro analyst who has tracked this specific ratio for years describes the current formation as a slingshot pattern, a decade of compression building energy, a lower time frame breakout already in motion, and the acceleration phase. The part where the ratio moves fast loading directly ahead, the compression is built, the initial breakout has triggered. What comes next in these patterns historically is not a slow grind. It is a repricing that catches most investors completely off guard because they were still looking at stock prices, not at what stocks are worth, relative to real things. Now let us talk about why the timing of this matters more than usual, because this is where the macro environment makes the setup sharper and more urgent than it might otherwise be. The mainstream narrative being pushed across financial media right now is straightforward. Inflation is essentially defeated. The Federal Reserve is in a position to normalize rates. Growth stocks, especially in artificial intelligence, are the obvious place to park capital because earnings are strong and rates are coming down. That narrative is mathematically flawed, and the flaw is not subtle. The largest technology companies, the hyperscalers running the AI infrastructure build-out, just reported first quarter 2026 earnings that looked spectacular on the surface. Headline earnings per share growth of 27% year over year, that number alone fueled another leg higher in technology stocks and gave the bull market narrative another burst of fuel. But if you actually read past the headline, if you open the earnings reports and look at where those profits actually came from, the picture changes completely. A major portion of that 27% earnings jump did not come from operating businesses growing. It did not come from products sold, services delivered, or customers paying more for AI tools. It came from a line item called other income. Other income is the accounting category that includes one-time gains, paper valuations of private company investments, and gains from holdings in firms like OpenAI and Anthropic that are valued internally but have never actually been sold for cash. In 2016, other income represented roughly 2% of hyperscaler net income. By 2021, it had climbed to 12% and then pulled back. Then came the spike that should concern every investor paying attention. In 2025, other income climbed to 13% of total net income, and in the first quarter of 2026, it exploded to 34%, more than one-third of the headline. Profits the technology sector reported this quarter came from paper valuations of private companies, not from businesses generating real cash. This kind of earnings composition has a specific historical fingerprint. It appears at valuation cycle peaks, when companies begin booking large gains from investment portfolios rather than from operating revenue. The underlying economy is almost always weaker than the headlines suggest. The gap between what the numbers say and what is actually happening in the real economy is widest precisely at the moment when most investors feel the most confident. Hila Meisler, a market technician with over 4 decades of experience, reading us markets, summarized what she is seeing in one line this week. If you were not trading in 1999 and 2000, she said, then you are in luck. This is what it was like. Now you can experience it. A multi-decade veteran of U.S. equity markets explicitly comparing the current setup to the dot-com peak is not a casual observation. That is someone who has seen every cycle of the last 40 years looking at today and recognizing the fingerprints. The setup is not just familiar, it is almost identical. And while the paper asset complex continues printing record highs on earnings that are increasingly disconnected from operational reality, something else is happening in the physical world, something the financial media has barely begun to cover. The commodities themselves are already moving. The Bloomberg Industrial Metals Index closed last Friday at the highest level since June of 2022. That index tracks copper, aluminum, zinc, nickel, lead, and tin, the raw materials that physical economies are actually built from. After 3 years of compression following the 2022 peak, the breakout above multi-year resistance is now confirmed on the weekly chart. This is not a rumor, it is a price level, and what makes it more significant than a typical technical breakout is the context surrounding it. This is happening at the same moment the CRB-to-Dow ratio is hitting 50-year extremes. At the same moment the S&P breadth divergence is flashing its fourth signal in 100 years. At the same moment paper earnings are being inflated by the same accounting mechanisms that appeared at the 1999 peak. These are not separate stories. They are the same story being told in 4 different data sets simultaneously. Copper is the clearest single confirmation. On May 11th of this year, copper hit a new all-time high above 620 cents per pound. That is a record, not a multi-year high, not a recovery from a dip, a record that wipes out every prior cycle peak copper has ever printed in its trading history. And the structural reason for that move is not complicated. Every major infrastructure build-out currently underway, artificial intelligence data centers, electric vehicle production, grid modernization across the United States and Europe requires massive quantities of copper. There is no substitute. You cannot build a data center without it. You cannot manufacture an EV battery system without it. You cannot upgrade an electrical grid without it. And on the supply side, the response from miners has been essentially non-existent because new copper mines take roughly 15 years to permit, finance, and construct. Demand is rising fast. Supply cannot respond quickly. That is not a speculative thesis. That is a physical constraint. The price is telling you what the physical market already knows. Silver is showing the same pattern. Silver trades with a dual identity. It is both an industrial metal required for solar panels, electronics, and EV components, and a monetary metal that moves with gold during periods of currency concern. Both of those drivers are operating simultaneously right now. Silver has broken above the $80 level, and the technical structure points toward a move into the $90 range in the coming weeks as multiple structural forces converge on the same upside pressure. Gold continues to print new all-time highs above $4,700 per ounce. The pattern across every major commodity category, energy, metals, agriculture, is identical. Years of compression followed by a confirmed breakout followed by an acceleration phase that historically moves faster and further than most investors position for. Now let us talk about what is underneath all of this at the macro level, because this is the slow-moving pressure that makes the entire setup self-reinforcing, the layer that does not show up in any single data point but becomes visible when you zoom out. The consensus narrative across Wall Street and financial media is that the inflation threat is behind us, that the Federal Reserve successfully navigated a soft landing, that capital can safely stay concentrated in growth equities because the rate environment is normalizing and the AI earnings cycle is real. Here is what that narrative misses. The structural inflation pressure that built up over the last decade did not disappear. It was temporarily masked. Energy supply constraints that developed through underinvestment in fossil fuel production during the ESG capital rotation of the 2010s have not been resolved. Deglobalization of manufacturing, the reshoring of supply chains that accelerated after 2020, is inherently inflationary because it replaces cheap foreign labor with more expensive domestic production. And the currency debasement that accumulated from running the largest peacetime deficits in US history has not been absorbed. It has been deferred. When the masking effect of short-term cyclical disinflation ends, and the historical record is clear that it always does, the structural pressure reasserts. And when it does, the rotation dynamic is not gradual. It is violent. Money that has been sitting in paper assets repriced on optimistic earnings multiples moves quickly into mathematically scarce physical assets. Gold and silver lead that rotation historically because they are the most liquid and most universally recognized monetary hedges. Industrial metals follow because the supply constraints make price discovery straightforward. Agricultural commodities accelerate because food security concerns layer on top of currency concerns, and the entire complex reprices simultaneously, not over years, but over quarters. That is what 1980 looked like. That is what 2000 through 2011 looked like. And that is what the current dataset is positioning 2026 to repeat at a more extreme starting compression than either of those prior cycles. Here is what to actually watch over the coming weeks, because understanding the thesis is not enough. You need specific signals that tell you whether this is unfolding on the fast timeline or whether the market needs more time. The first signal is the CRB-to-Dow ratio itself. This is the master indicator for the entire thesis. Tracking it weekly, which you can do through any standard financial charting platform, tells you whether the slingshot is firing or consolidating. Any sustained move above the recent breakout level on weekly closes confirms the acceleration phase is active. A reversal back into the compression zone would signal that the rotation is delayed and that a further accumulation window is opening rather than closing. The second signal is S&P 500 breadth. Watch the percentage of index members hitting 52-week close week over week. If that number continues climbing beyond 5% while the index itself holds near highs, the bearish divergence is intensifying in real time. This is exactly what the internal structure looked like in the second half of 1999. The index kept grinding higher on the surface while the deterioration underneath was accelerating. The third confirmation is copper price action. The initial breakout above 620 cents per pound is confirmed. What you want to watch now is whether copper sustains weekly closes above 650. That level represents the threshold between a breakout that is real institutional positioning and one that could stall into another consolidation. Any failure back below 550 would mean the breakout structure needs more time and another base building phase. The fourth indicator is gold and silver mining stocks relative to spot metals prices. The Philadelphia Gold and Silver Index, the ZO, is the cleanest measure of whether institutional capital is positioning ahead of the next leg in metals prices. Mining stocks historically lead the largest price acceleration phases because sophisticated. Money buys the equities before the commodity prices fully reprice. When miners outperform spot metals on a sustained basis, that is the smart money telling you something the spot price has not yet fully reflected. The fifth and final signal is the AI hyperscaler other income readings in the next earnings cycle, second quarter 2026. Reports will land in July. If other income stays above 20% of net income in those reports, the paper valuation distortion is structural, not a one-quarter anomaly, that would mathematically replicate the accounting fingerprint of the 1999 peak and would confirm that the earnings foundation supporting technology valuations is built on paper, not on operational cash generation. Track these 5 signals together. They are not independent. They are the same underlying story expressed in 5 different markets simultaneously. And when they all point in the same direction at the same time, which is what is happening right now, the historical record says the result is not a small correction and a recovery. It is a paradigm shift. The investors who understood the 2000 setup and positioned into commodities and hard assets at that bottom captured roughly 10 times returns over the following decade. Not in aggressive speculative vehicles, in gold, in silver, in copper-linked assets, in energy, the investors who waited for mainstream confirmation. For the financial media to start covering the commodity bull market entered after the majority of the move was already complete. The current setup is showing the same compression pattern at a more extreme reading than 2000. The math is not a matter of interpretation. The CRB-to-Dow ratio is at 50-year extremes. The S&P breadth divergence has fired for only the 4th time in a century. Industrial metals have broken out above multi-year resistance. Copper has hit an all-time record. Gold and silver are accelerating. The AI earnings foundation is showing the same paper valuation inflation that characterized the 1999 peak. Every condition required for the largest paradigm shift in modern financial markets is operating simultaneously right now. The question is not whether this is a real setup. The data has answered that. The question is what you are going to do with the information. Because the investors who act on setups like this before the mainstream narrative catches up are the ones who capture the full move. The ones who wait for permission from financial television are the ones who buy the magazine cover. Tell me in the comments, are you already rotating into hard assets? Are you holding through this and watching the signals, or are you still fully positioned in stocks? I read every single comment. If this analysis gave you something worth thinking about, hit the like button on your way out. It takes 1 second and it helps Recession Warnings reach the investors who need to see this before the window closes. Subscribe and hit the bell so you do not miss the follow-up when these signals develop further. This is Recession Warnings. Stay alert.